There's something happening in the gold market right now that most people are completely missing. And I don't mean missing in the casual sense. I mean the kind of missing that people look back on 5, 10 years from now, shaking their heads, wondering how they could have had all the information right in front of them and still failed to act. The kind of missing that costs people their financial security, their retirement, their peace of mind. So here's what I want you to do. I want you to set aside everything you think you know about gold for the next few minutes. Forget the headlines, forget the noise, forget whatever your financial advisor told you at your last meeting, because I'm going to show you something that's unfolding in real time, a breakout that the data is confirming, that the smart money is quietly positioning for, and that the vast majority of everyday investors haven't even begun to register. Let me start by painting you a picture. Imagine you're standing outside a building. Inside that building, something extraordinary is happening. A crowd is gathering, deals are being made, money is moving. But from outside, from where you're standing, it looks completely quiet, looks normal, nothing to see here. You don't hear the noise, you don't feel the energy, you don't know what you're missing because the walls are thick and the windows are dark. That's exactly where most investors are standing right now, with gold. The walls are the financial media. The dark windows are the mainstream narrative. And behind those walls, behind those windows, gold is making one of the most significant moves it has made in a generation. Quietly, methodically, without fanfare, without the kind of breathless CNBC coverage that would tip off the retail crowd and send them piling in. This is the move that happens before most people know it's happening. And by the time most people figure it out, the easy gains are already gone. So let's get into it. Let's talk about what's actually happening. Gold is currently trading around $4,300 per ounce. Let that number sink in. This is not a typo. This is not some speculative projection from a permable analyst who's been calling for a gold explosion since 2009. This is the market price, right now, today. A year ago, gold was trading nearly $1,000 per ounce lower. In 2025 alone, gold surged roughly 60%, one of the most remarkable single-year performances in its modern history. But here's the paradox that makes this breakout so unique, so unusual, and frankly, so important for the people watching this video right now. Despite that historic move, the data from the Commodity Futures Trading Commission, the CFTC, which publishes what's called the Commitments of Traders report every week, that data is showing us that speculative net positions in gold futures have actually been declining. As of just this past week, speculative net longs sit at around 173,000 contracts. That number has been falling. In plain English, the crowd hasn't shown up yet. The speculators who pile in when they smell a trend, they're not here in force. The retail investors who chase momentum, they're not here. The people who got burned in the January and March sell-offs earlier this year and swore off gold, they're sitting on the sidelines, watching this thing unfold without them. And that, right there, is the opportunity. Because when you understand how breakouts actually work, and I'm not talking about the textbook version, I'm talking about what happens in the real world with real money. The most powerful moves happen precisely when the masses haven't noticed yet, when the fundamentals have already shifted, when the institutional accumulation has already begun, when the smart money has already positioned. But before the retail crowd creates that final explosive surge that takes prices to levels nobody thought possible. That's where we are right now. Actually, before we go deeper, if you check the description below this video, I put together a free guide that walks through the saving strategies that thousands of American retirees are using right now to protect their hard-earned wealth from exactly what we're discussing. It takes 5 minutes to read, and it's completely free. The link's right there in the description. Go grab it and then come back, because what I'm about to share with you gets even more important. Let me tell you about the January crash, because understanding what happened in January of this year is actually the key to understanding why this breakout matters so much. Gold hit extraordinary levels coming into the new year. Retail investors, regular people who saw the headlines, who watched the price climb, and decided they wanted in, poured money into leveraged gold ETFs. These are exchange-traded funds that use financial engineering to give you 2 times, sometimes 3 times the daily movement of gold. They sound great when the price is going up. They're catastrophic when it goes the wrong direction. On January 30th, gold experienced what the Bank for International Settlements later called a move of more than 10 standard deviations. That's not a typo either. 10 standard deviations. In statistical terms, that's an event that should essentially never happen. It's the financial equivalent of flipping a coin and getting heads 50 times in a row. Gold dropped 11% in a single day. The leveraged ETF holders got wiped out. The people who piled in chasing momentum watched years' worth of gains evaporate in hours. The retail crowd, predictably, tragically, panic sold at the bottom. And here's what the institutional money did during that same period. According to Wisdom Tree's analysis of the sell-off, the physical demand remained resilient. The real buyers, central banks, sovereign wealth funds, institutions with long-term mandates, they didn't panic. Some of them actually added to their positions because they understand something that most retail investors never learn until it's too late. The price of gold on a given Tuesday doesn't matter. What matters is the structural forces that determine where gold's price is going over the next several years. And those structural forces, they have never been more bullish. Not in the last decade. Arguably not in the last 50 years. Let me walk you through them. Let's start with what the central banks are doing, because this might be the single most important thing happening in the global economy right now, and almost nobody is talking about it in plain language. Morgan Stanley's research team published something remarkable recently. Gold has now surpassed U.S. Treasuries in central bank reserves for the first time since 1996. Read that again. Gold is now a bigger part of global central bank reserves than American government bonds. This is a seismic shift. This is the financial equivalent of an earthquake that changes the landscape permanently, not temporarily. Why are central banks doing this? Why would the monetary authorities of nations around the world, entities that have access to the best financial analysis on Earth, that employ entire departments of economists and strategists, why would they be choosing gold over treasuries? Because they know what's coming. They see the same data you and I can see, but they also see what we can't. They see the internal projections. They see the sovereign debt trajectories. They see the currency pressures building beneath the surface of the global economy. And what they're telling you with their actions, not their words, their actions, is that they want physical gold in the vault. Now, let's talk about BRICS, because this is where it gets geopolitical. And geopolitics is something that most American investors don't factor into their financial planning nearly enough. Brazil, Russia, India, China, South Africa, collectively, these nations hold approximately 20% of the world's known gold reserves, and they have been making deliberate, methodical moves to reduce their dependence on the US dollar as the world's reserve currency. This isn't conspiracy theory. This isn't fringe analysis from some newsletter writer in his basement. This is documented in official government communications, in central bank reports, in research from institutions like the Asia Times and the BIS itself. The BRICS nations are building alternative payment systems. They're settling trade in local currencies. They're accumulating gold as a neutral reserve asset that doesn't require trusting any single nation's government. Think about what this means for demand. You have nations collectively representing billions of people and trillions in economic output, making a conscious, coordinated decision to move out of dollar-denominated assets and into gold. That's not a trend that reverses in a quarter. That's not something that gets unwound because the Fed says the right thing at a press conference. That's a structural, generational shift in how the world thinks about money, and gold is at the center of it. Now, let me add another layer to this. Let's talk about inflation. Because here's something that should alarm everyone watching this video right now. US inflation has risen back to 4.2%. That's not where the Federal Reserve wants it. That's not where the headlines want it. But that's where it is. And the energy component of that inflation, driven by ongoing geopolitical tensions, jumped more than 20%. Meanwhile, the Fed is holding interest rates between 3.5% and 3.75%. They're not cutting, they're not raising, they're holding. And here's the trap that holding creates. If you're a retiree, if you're someone who spent 40 years building a nest egg, and you're holding that nest egg in traditional assets, stocks, bonds, savings accounts, you're watching inflation eat your purchasing power alive. Real interest rates, when you subtract actual inflation from what your savings account is paying you, are either negative or barely positive. The purchasing power of a dollar is eroding in real time. Gold doesn't pay a yield. Gold doesn't send you a dividend check. But gold also doesn't get destroyed by inflation. It doesn't get printed by a government running a deficit. It doesn't get bailed out when the system breaks down. For 5,000 years of human civilization, gold has preserved wealth. through empires rising and falling, through currency collapses, through wars and depressions and hyperinflationary spirals. Let me tell you a story about 1971 that I think is worth sitting with for a moment. On August 15th of that year, President Nixon went on national television and told the American people that the United States was suspending the convertibility of dollars into gold. This was the end of the Bretton Woods system, the end of the gold standard, the moment when the dollar became, in the technical economic sense, entirely fiat, backed by nothing but the full faith and credit of the US government. At the time, gold was fixed at $35 per ounce. Within a decade, after that anchor was removed, after the dollar became untethered from any hard asset, gold rose to more than $800 per ounce. That's a gain of over 2,000% in 10 years. Not because gold suddenly became more valuable, but because the dollar, once freed from its golden anchor, began its long, slow, inexorable drift toward debasement. That drift has never stopped. We are now living with the accumulated consequences of 50-plus years of fiat monetary policy, trillions in government debt, deficits that don't get smaller regardless of which party is in power, a national debt that is, by any reasonable accounting, impossible to pay off through ordinary means, and a Federal Reserve that has only two real tools when the next crisis comes: print money or cut rates, both of which are inflationary. The people who understood this in 1971 and bought gold did extraordinarily well. The people who didn't, who trusted that the dollar would hold its value, who kept everything in paper assets, watched their purchasing power erode decade after decade. Here's where we are right now. JP Morgan's global research team, not a Goldbug newsletter, not some permabull analyst, JP Morgan, is projecting gold could reach approximately $6,000 per ounce. That's roughly 40% above where we are today. Morgan Stanley's target sits around 4,400 by year end. Even the more conservative institutions are building the case that this move has room to run. And none of that accounts for what happens if we get a genuine financial crisis, if we see the kind of credit event that the sovereign debt trajectory is actually pointing toward. Because here's what history teaches us about gold in crisis moments. It doesn't just hold value, it accelerates. During the 2008 financial crisis, gold initially sold off, just like it did in January of this year, as leveraged players needed cash. But then it did what it always does after those panic sell-offs. It roared back. From the bottom of the 2008 crash to its eventual peak in 2011, gold went up more than 200%. The pattern is familiar because human behavior is consistent. Crisis hits, people panic, they sell the good stuff to raise cash. And then, once the dust settles, once the smart money recognizes the bargain, the fundamentals reassert themselves and the price launches. The March 2026 sell-off, where gold fell 12% in its worst monthly performance since 2013, was that kind of moment. And what has the market done since? It has recovered. It has rebuilt. And according to the technical analysis from multiple independent sources, it is now attempting to break above key resistance levels in a move that, if it holds, could signal the next major leg higher. Now, I want to pause here and talk to you directly, because if you've been watching this video and you're in or near retirement, if you've spent decades building a nest egg and you're trying to figure out how to protect it from everything we've been discussing, there's something specific I want you to know about. There's a way to hold actual physical gold inside a retirement account. Not a paper promise, not an ETF that holds futures contracts, but real allocated physical gold in a vault inside a tax-advantaged retirement structure. It's called a gold IRA, and for the right person, specifically someone who has significant retirement savings and is genuinely worried about what inflation, currency debasement, and potential market instability could do to their portfolio, it's worth understanding deeply. Look, I'm not here to tell you what to do with your money. That's between you and your financial situation. But if you've got retirement savings sitting entirely in stocks and bonds, and you're watching inflation at 4% and a stock market that's been volatile and a government debt trajectory that keeps you up at night, the idea of having a meaningful percentage of your retirement wealth in physical gold held inside your IRA is at least worth learning about. It's worth a conversation. Because the hedge that those central banks are making, the same hedge that's driven gold above treasuries and global reserves for the first time since 1996, that same hedge is available to everyday American retirees. Not just the sovereign wealth funds, not just the institutional giants, you. Check the description for the guide I mentioned earlier if you want to explore this further. Now let me bring it back to the bigger picture, because I want to make sure you understand not just what's happening in gold, but why I'm calling this a breakout, and what most investors haven't noticed actually means in practice. The CFTC data tells us that speculative positioning is not elevated. That means the momentum chasers aren't here yet. The gold bull market of 2025 was driven heavily by institutional buying. Central banks, ETF flows from pension funds, family offices rotating out of bonds. The retail crowd chased it at the top, got burned in January and March, and is now largely on the sidelines. That's actually a healthy reset. That's the kind of washout that sets the stage for the next move. Meanwhile, the fundamentals that drove the original rally have not just held, they've strengthened. Inflation is higher than the Fed wants. The geopolitical environment has gotten more complex, not less. The BRICS de-dollarization agenda is moving forward. Central bank gold accumulation, particularly from China, where the People's Bank of China is believed to be conducting purchases that are not fully reported in official data, continues. The structural demand is there. The long-term drivers are intact, and the speculative excess has been washed out. When all of those things are true simultaneously, strong fundamentals, washed out sentiment, declining speculative positioning, that's historically been a very interesting setup for precious metals. Let me tell you about another historical parallel. 1976. Gold had made an initial massive move after Nixon closed the gold window in 1971. Then it consolidated, corrected sharply, and by early 1976, the headlines were calling the gold bull market over. Analysts were declaring that gold had peaked, that the inflation trade was done, that people who owned gold were missing out on better opportunities elsewhere. The skeptics felt validated. Gold then proceeded to rise roughly 700% over the next 4.5 years. The people who were shaken out in that 1976 correction, who sold at the bottom, who believed the narrative that the bull market was finished, those people watched from the sidelines as the gold market did exactly what it does after every significant consolidation. It resumed its primary trend with even more force. Now, I'm not telling you that history will repeat identically. Markets never do. The specific numbers, the specific timing, the specific catalyst that ignites the next leg, those are unknowable in advance. What I am telling you is that the fundamental architecture of this gold market looks remarkably similar to the setups that preceded the biggest moves in gold's modern history, and most investors haven't noticed. Here's the thing about most investors haven't noticed. It's not an insult. It's not a commentary on intelligence. It's just the reality of how information flows and how human psychology works. When gold was making headlines, when every financial media outlet was running stories about the price surge, when people at dinner parties were talking about gold, that was actually the dangerous time to be buying. That's when the marginal buyer, the last person to hear about something, enters the market and becomes the person holding the bag when the correction comes, when it all comes down. Right now, the dinner party conversations are not about gold. People are talking about AI stocks, they're talking about whatever is in the news cycle. Gold feels like yesterday's story to most casual observers. The crash in January, the sell-off in March, those events reinforce the narrative for a lot of people that they missed the move, that the gold trade was over. But look at what the data shows. Gold is trading at multi-year highs. The fundamental drivers are stronger than ever. The smart money, central banks, sophisticated institutions, is still accumulating. And JP Morgan is quietly publishing research projecting prices significantly higher. This is what the beginning of a breakout looks like. Not fireworks, not unanimous agreement, not everyone talking about it on social media. It looks like price quietly moving higher while most people are still convinced the opportunity has passed. And that brings me to the most important question. What do you do with this information? I'm not here to tell you to go buy gold tomorrow, sell everything else, and bet the farm on a single commodity. That's not what smart wealth protection looks like. What it looks like is being informed, understanding the forces at work, having a thoughtful conversation about whether your current portfolio positioning actually reflects the world we're living in, a world of elevated inflation, currency debasement risk, geopolitical uncertainty, and a sovereign debt trajectory that keeps institutional strategists up at night. If you're in or approaching retirement and you have meaningful retirement savings, the question isn't whether you've heard about gold. The question is whether you've actually thought through what it means for your financial security, if even a portion of what we've discussed tonight plays out. if inflation stays elevated, if the dollar continues its long-term trend of purchasing power erosion, if the geopolitical fractures that central banks are already hedging against get more serious, not less. The guide in the description, the free one I mentioned earlier, walks through exactly how people are approaching this, how the tools work, what options are available. It's not a sales pitch, it's education. And in an environment as complex and as consequential as the one we're navigating right now, education is the most valuable asset you can hold. For those of you who've made it to the end of this video, first of all, thank you. It means you're serious about understanding what's happening in the markets and protecting your financial future. And because you stuck around, I want to let you know about something exclusive. If you go to the description and reach out through the guide link, and you mention that you watched all the way to the end of this video, there's an opportunity for a complimentary one-on-one educational web conference. No obligation, no pressure, just a conversation with someone who can walk you through the specifics of your situation. This is available for American retirees who have at least $100,000 in any retirement account, IRA, 401k, pension, whatever you've built. If that's you and you want to have an intelligent, informed conversation about how to position your wealth for what's coming, that offer is there. The breakout has started. The data confirms it. The fundamentals support it. The question is whether you're going to be one of the people who noticed while it mattered, or one of the people who looks back later and wonders how they missed it.